The following video is an excerpt from a recent CSI Live from over on Semiconductor Insider, where we were talking about how we allocate capital, diversification, how we select companies, and in this particular episode, software companies. Make sure you check out Semi Insider. You can find all of our research there and a growing number of investment tools to help you track the world's most important technologies and help you sift through all of the mountains of needless noise out there.
You can find that only over at our website, chipstockinvestor.com. Make sure you sub to the channel, subscribe to the newsletter, and we'll see you over there. Let's get into this.
Small and mid caps is why we keep coming back to cybersecurity. One of those adjacent industries, adjacent to semiconductors and hardware. Why is that, Kasey? Just as a refresher.
It's kind of a big deal. Cybersecurity is a big deal. Many of you have seen this chart a ton. This just illustrates how big of a market the cybersecurity industry is. $215 billion in global spend last year. And that's expected to continue to grow around a 12% rate over the next 5 to 7 years. So let's talk a little bit about Rubrik, because it's one of the smaller cybersecurity companies that seems to have all of the ingredients necessary to make it a platform cybersecurity company, which is a hot deal right now and more necessary than ever. When we're looking at Rubrik, this is where we would place that, is more in the storage portion of where security is needed. Rubrik focuses on cybersecurity in the storage area and cloud storage.
Yeah, because remember, the chips get installed, the infrastructure, hardware gets installed, and if you're a business and you just install some new infrastructure, what do you do next? You make sure it's safe so that your new asset doesn't get rendered worthless or cost you a bunch of money. The rules are a little bit different because of a hyper-connected world that we live in, but that's why cybersecurity is a secular growth trend, kind of piggybacking off of the semiconductor industry. Something new happens in network infrastructure, cybersecurity is hot on the heels of that.
And we have these two segments in market segments, Mark, the accelerated computing and AI infrastructure, re-accelerating growth there, and then cloud and enterprise, which is also part of cybersecurity, new growth cycle. And you might be wondering why Rubrik has not really bounced back after cybersecurity took a hit. Of course, SaaS apocalypse, most of those companies have come back. Rubrik's been a bit of a laggard.
Or at least the big ones came back. Yeah, catch the update in early March that we did on cybersecurity. We did a big refresh. For a couple of years now, we've been talking about the necessity of these companies to do the whole platformization thing. We believed that the commentary coming from Nikesh Arora, CrowdStrike, George Kurtz, and some of the others, Fortinet, about the need to consolidate the industry. We believed that narrative. We thought that that was very much a thing. And sure enough, they have recovered. Their profit margins have stayed strong. But when you look at that end market chart that we had up before, when you have this big cycle of growth for AI infrastructure and enterprise infrastructure, if you're a smaller business, yes, you might get a revenue acceleration as a result of these growth trends, but it also means you're probably also having to invest yourself, which means potential profit margin compression. So to your point, Kasey, that's why companies like Rubrik have not fully recovered and reached new all-time highs like some of the bigger platforms have. So let's break down the financials.
Yeah, let's take a look at that. This was from the most recent quarter. Good numbers here. The subscription ARR on the left continues at over 30%. And then the revenue growth year over year on the right. There's two different bars there, reported revenue versus normalized revenue. We'll just focus on the reported revenue. They had a change in the business model, and those two numbers are converging now. Close to 40% growth on reported revenue year over year. This illustrates it a little bit differently. You can see that their revenue continues to grow. Free cash flow has stalled out a bit. And that's what Nick's talking about and what we're going to show you a little bit more here. Let's take a look at that on a per share basis as well.
Yeah, it's still good on a year over year basis. They still had a big jump in free cash flow and also free cash flow on a per share basis, which is how you get the adjustment for stock-based compensation that a lot of people on the internet continue to harp on. But to their point about expenses increasing, you can see on a sequential basis, the free cash flow, as you said, it's stalled out. And thus also on a per share basis, it has stalled out. 77 million in the latest quarter. So that's exactly what you were talking about, that the higher expenses, margin compression is happening here. Obviously, AI is necessitating smaller companies like Rubrik having to spend a lot more than maybe some of their larger, better funded, more self-sustaining peers.
And then here's a look at their balance sheet with that spending. Actually still pretty healthy. Total cash at 1.7 billion and long-term debt at 1.1 billion. Not able to pay down too much of the debt because they're spending, but this is not bad.
No, it's good. And because free cash flow is positive, the net cash on balance is steadily climbing.
But this is where we need to look at their growth rates. This is their Q2 fiscal year 2027 and the full year fiscal year 2027 guidance. Implied rate of growth is slowing down. 28% year over year growth for the quarter in Q2 fiscal year 2027 and 26% year over year implied growth for the full year. And then down there at the bottom, you can see free cash flow around 20% year over year growth. So why hasn't Rubrik bounced back? Margin compression. So this is something we need to continue to watch. If it does, it might be all right.
This is the trick with smaller businesses. You do kind of want this, right? This is how it works. It's not a big mature business where you expect results to be a bit more smooth. When you invest in small and mid-cap businesses, you expect, because of the higher growth rate, you're going to have periods where the stock may outperform for pretty long stretches of time, maybe a year or two, or sometimes even longer than that. And then boom, suddenly they prove it. All the AI investments being made in Rubrik Security Cloud right now, maybe next year, suddenly pay off big time. And free cash flow more than doubles. And then the market cheers and everybody is like, oh, they turned things around. And no, really, investors were just impatient and we just like to see stock prices do nothing but go up. But that's not how it works. This is why you invest in smaller businesses. You're hoping for a differentiated return, different from what's happening in the here and the now. Your hottest picks of 2026, they're not going to just continue to be the hottest picks for forever. So you might want to add some positions like this where you think, I think in a year or 2 or 5, Rubrik is going to be okay.
It makes so much sense when you say it like that.
Things don't go just up for forever all the time.
And the businesses that you think now are not doing exactly like all the other businesses that you have in your portfolio, maybe that business will do something different in the future because they've been investing in their business.
And you can get pretty fancy with this too. I kind of like looking at Sharpe ratios, especially analyzing the portfolio performance, which measures your risk-adjusted rate of return. Yeah, maybe you can pull off a triple-digit one-year return, but at what cost? So you can use things like the Sharpe ratio or the Sortino ratio to kind of get fancy about it. But ultimately, at the end of the day, all of that is based on allocating capital first, places that are going to provide you a return right now, but also, more importantly, also allocating capital to a place that will give you a good return in the future as well. So it has to be a balance. Memory and optical networking are all the rage at the moment, but it's not going to just last that way for forever. And so possibly cybersecurity, maybe some of these smaller companies that are trying to emerge as a bigger platform, maybe this is one of those future winners. History says cybersecurity is a tough market to crack, but what else is new? That's just the name of the game for small and mid-cap businesses. It's tough.
Okay, this is a reverse DCF from a number of months ago, back when the stock was around $89 per share. And it's down to about 70 right now. So let's just take a little walk down memory lane and see what was baked into the stock price at this time. Per share profit growth of 60% over the next 3 years based on free cash flow per share, terminal growth rate of 6%. Really high bar. So let's take a look at a reverse DCF right now.
And to be clear, they did pull off that kind of year over year free cash flow per share growth. Not on a sequential basis, but year over year, they did pull that off. And that's why you see this new scenario. The 3-year growth rate has been lowered, basically cut in half. So that's partially the stock price dropping close to 20% compared to the last time we did a scenario like this, but also the free cash flow per share now being much higher than it was. The bar is still high, but if you think Rubrik can continue to scale the business, maybe this period of free cash flow margin compression is temporary, it's still a doable scenario. I will say, though, some of the big, dramatic year-over-year increases in free cash flow per share have now just happened. They were scaling off of close to zero free cash flow early on in their publicly traded journey. So it's not going to be triple-digit increases, more than likely, anymore, but they are still scaling off of a small base of free cash flow. So in our view, while this isn't a deal of a lifetime, the best cybersecurity stock purchase you'll ever make, more than likely not. But the scenario looks somewhat reasonable. So if you need some smaller or mid-cap exposure, you don't have much going on in cybersecurity.
You like the color scheme. It's a very pleasant looking color scheme.
Yeah, nice blues and greens. Yeah. And it is a unique asset coming at it from data security and data backup versus some of the older network security players like Palo Alto, Fortinet, endpoint security with CrowdStrike. This is a bit different with data security.
So there you go.